From the morning headlines, given bulls a very modest tailwind, seasonality ahead of the Easter holiday has tended to favor modestly higher prices. Indeed, we've got a number of seasonality factors that come into play this week. We have the end of the month and end of the quarter. We have the first day of the month, and we have the Easter holiday. And then we have the April, which is traditionally a very strong month, but it's quite a bifurcated approach. You have the tendency to sell off as people gather money to pay their taxes, and then the strong bounce back often in the second half of the month. So a lot of factors coming into play, not just this week, but in the trading weeks to come. Buying power available to investors is near an all-time low. The New York Stock Exchange available cash figures dropped to one of the lowest levels, and the last two times it was near this level, stocks struggled in the months ahead. Also notable is that the ratio of assets in equity mutual funds to assets in safe money market funds has reached a new high. That has long-term concerns, but even in the near term, stocks struggled in the months following the other times in recent years that the ratio was close to this extreme. Other news: the combination of a two-day rally, low volume, and a close below a short-term high seems to suggest more upside is likely for the next few days. And then with the first of the month seasonality, like the old gray mirror, the first of the month just ain't what she used to be. If you look at the performance of the first day of the month compared to the seasonality of other days of the month for the time frame of 2000 to 2010, well, that was clearly quite bullish. But the seasonality of the first day of the month in the last 4 years has been very, very neutral. So is the seasonality trend of the first day of the month still holding true? Macro data has become a concern as it has pushed earnings expectations to the lowest in years, with investor sentiment also remaining near a multi-year low, while the multi-year trend line for the S&P continues to hold as support. Hello, this is Stephen Harris, head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:23 a.m. Central Time, and I'm recording this in preparation for the market day of March the 31st, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in. There was quite a bit of action to the overnight session. We have with our own broad market indices, we're down about 0.5% at the time of this cut across all four, with the S&P perhaps being the most bearish. You had a big move in crude oil, down over 2%. Euro was also down about 0.7. Bonds were up about 0.2. Gold essentially scratch. This pattern also follows in the overseas markets. China was down about 1%. Japan was down about 1%. Germany was down nearly 1%. United Kingdom also about 1%. Only Hong Kong was positive, and that was marginally. In terms of macroeconomic reports for the day, we do have right now FOMC member Lackey speaking, and then we have Chicago PMI later after the market opens, and consumer confidence. So a couple during the market session macroeconomic reports for the U.S. markets today. Don't have tomorrow because there were so many reports listed for today. That was all that was room for on the morning report. In terms of volatility, we basically are what we would call range bound in the volatility, much like the markets. The short-term VIX was at a 14.31. You have implied IV percentiles all still relatively low, with the Dow being the highest and the others really in the bottom third. Do notice though that standard deviation moves have not been low, and indeed if you look at the S&P here, you look at this 1, 2, 2, 1, 1. Indeed the count for the last 10 trading days is 7. We have had significant standard deviation moves, and the incident rate of those moves is also very high. We went through a pattern a couple weeks ago with 9 trading days in a row of oscillating between standard deviation moves and not, and we seem to have picked that back up. So a lot of sideways action, but significant move within that range. And this week, given all the seasonality factors that we mentioned at the start of the broadcast, that could very easily continue all the way through Thursday. In terms of our daily report for futures rollovers, I did check into this. There are no futures rollovers in any of the markets that we follow in the next few days, so all clear from that standpoint. Market trend, the intermediate term phase remains phase 3. We are looking for higher highs and higher lows given the longer and intermediate term phases, but that being said, obviously if you look at the chart, it is much more and better described as being range bound. From a portfolio investor posture, IBD status is uptrend under pressure. GMI did improve pretty dramatically yesterday. We had a nice bullish candle yesterday, though it would have been more impressive if more of that uptrend had been painted during the full participation of the trading day as opposed to the gap and kind of and then mostly stall. Also, when you look at the volume of yesterday's up move, not exactly a super strong sign. Though the candle itself, very bullish, the way it formed and the action during the day certainly was quite bullish, so we certainly do not discount that. Active trader market posture, though, remains quite bearish and really continued to be bearish even with yesterday's action. Position sizing opinions from an investor standpoint up to 50%. So that certainly is a warning, though again the VIX remains within this window of 12 to 18, so from an active trader posture that would be a little bit more aggressive in the position sizing opinion, so kind of a couple mixed opinions there. Market timing models give 1-day outlook as neutral and 3-day outlook as neutral, so some cautionary tale there. Postures across all 4 of the indexes are decidedly bearish, and some of these are actually getting towards where they could go very bearish. If we drop below a 20, especially on the S&P, we would make this forecast opinion very bearish, and that could be a breakdown for something larger. In terms of our hedge warning status, we are still at level 1. And a number of factors coming into play. We did have a couple of the volatility measures come off and go back to their okay status, but we still have distribution day counts very high with 7 on both the S&P and the NASDAQ. VIX phase, we'll call it neutral. Obviously, we've been bouncing back and forth along with the range. Posture is poor. Yesterday, of course, was very good from the standpoint of new highs, new lows on the New York Stock Exchange. We had 234 new highs versus only 60 new lows. So that, certainly was a positive for yesterday. A negative that came in over the weekend that I should mention is on one of my indicators. It's what we call the crash warning indicator. This fires very infrequently, but it fired over the weekend. So this is not an indicator which is super time sensitive. In other words, it doesn't say, okay, the crash warning has fired, next day we're going to drop 10% or anything like that. But certainly in the relatively short-term time frame measured as days to perhaps a couple weeks, conditions are ripe that we could set up for a full-out correction, and the crash is defined as a 10% drop, and those conditions are present at this time. And this this indicator has a history that goes back many years, and looking back at the how often it fired versus did we have a 10% drop or greater in the days and weeks following that indicator firing. So that one is definitely one that gets my attention. From a intermarket risk aversion indicators, you notice all 5 of them are flagging as risk off at this point, so that also is definitely cautionary tales. Our option income strategies opinion, the VIX is still inside the acceptable window, and yet don't forget that what we saw with all of this standard deviation moves. I mean, if you're the type that does weekly calendars on an index, you've probably had to be very, very nimble, and it didn't seem probably like you were making much option income off of that approach. So we can get a situation, and we certainly have had this of late, where the VIX is, relatively tame and not a lot of fear, and yet at the same time, some of the option income strategies may be more sensitive to this kind of volatility that we're actually incurring than is being paid for and premiums being offered to take those trades. So be very careful with that. So it is in the acceptable window, but not all strategies are going to be equal in the current market environment. Cover call strategies continue to have this opinion of an equal distribution between in the money and out of the money strikes. And then finally, put selling. The marketplace could actually be setting up nicely for selling puts against a core portfolio basket of stocks that you're willing to own. But keep in mind, again, this crash warning and these other warnings, you may have a situation where a spike down is not just a spike down, but could become something larger. So keep that position sizing very much in play, and within the range of what you're willing to actually take assignment on. In terms of some of our overnight action in terms of sector market posture, notice that with the big bullish candle yesterday, we had a significant improvement on many of the sectors, especially in the short and intermediate term. But I would continue to draw your attention towards healthcare, retail, those sectors that are most consistent, that even when we have these down days, they tend to hold up better than the other sectors. And energy, of course, continues to be just going crazy, up 2% one day, down 2% the next day. Certainly it's a trader's environment, but if you're looking at making investing decisions, probably a pretty frustrating place to be. And you see healthcare and the other lower beta sectors, certainly not as volatile, and that certainly was true here with yesterday's action. In terms of industry groups, we continue to see retail, internet, healthcare, railroads, biotech as dominating the top of our industry group rankings. Credit to Shadow Trader there. So that is, I think, enough for today. As always, greatly appreciate you liking us on YouTube or on your other favorite social media platforms. It's always greatly appreciated that you invest back in us and recognize the work that we are doing with that effort. I would also, here's additional information at the website, email, disclaimers as always. Hit the pause button if you need more time to review the disclaimers. And finally, greatly appreciate you each and every trading day in the Falcon Global Trading community. We'll look forward to seeing you here, same place, tomorrow morning.